Looking at the latest news, there's this massive question hanging over the market right now.
Oh, absolutely. It's the only thing people are talking about.
Right, and it's all about the iShares Silver Trust. The financial behemoth everyone knows by the ticker symbol SLV.
Yeah, SLV. It's, well, it's everywhere right now.
Exactly. And the question is SLV caught in this like descending trend flashing these giant red cell signals? Or, and this is where it gets wild, is it a screaming strong buy that some analysts are still calling radically undervalued?
It's a huge divide.
Right.
I mean, the split in sentiment is crazy.
It really is. So today we are going to tear apart the technicals, the order flow, and, the actual physical supply chains to figure this out.
We have to look under the hood.
Right. But before we get into it, just a quick reminder, we are acting as your analytical guides on this deep dive today, not your financial advisors. So please do not take this as financial advice.
Yeah, definitely not financial advice, just educational.
Exactly. But what we found when we dug into this massive trust is, it's going to completely change how you look at commodities.
Oh, for sure. It's a totally different game than equities.
So before we figure out if this is a hidden gem or, a dangerous trap, make sure you hit that like button and subscribe to our YouTube channel. And it is absolutely compulsory that you drop your take in the comments below. We want to know what you think as we unpack this.
Yeah, let us know which side of the fence you're on.
So today is April 20th, 2026. And I think we need to start by looking at the sheer velocity of this asset because wow.
Yeah, the velocity is, honestly, it's what makes this whole situation so polarizing. I mean, we can't figure out if SLV is a trap today without, mapping out the historical volatility it's put investors through over the last year.
Right. Let's put some hard numbers to that volatility. So looking at the latest quote from the close on Friday, April 17th, SLV was sitting at just under $74, specifically $73.63.
Which is a huge move.
Yeah, that was a 3.35% gain for the day alone. It was trading in this tight little range between $73.42 and $75.16. But the stat that is just blowing everyone's mind right now is the two-week performance.
Oh, the two-week chart is parabolic.
It's up a massive 11.92% in just 14 days.
Which, a near 12% move in a physical commodity trust in 2 weeks, that is a seismic event.
Right, because this isn't crypto.
Exactly.
Yeah.
This isn't some microcap tech stock or a meme coin. This is a vehicle tracking a heavy industrial precious metal. So when an asset of this size moves that aggressively, it forces every institutional desk, every algorithmic trading program, and honestly, every retail trader to pay attention.
Everybody is watching it.
They have to. But, context is what separates the professionals from the gamblers here.
Okay, let's unpack this with some context then, which brings us to the 52-week extremes. Because exactly a year ago, back in May 2025, SLV bottomed out. It hit a low of $29.04.
Unbelievably cheap.
Right. And then the market just absolutely lost its mind. It sent the price rocketing to this astronomical 52-week high of $109.83.
Yeah, up near 110. Just incredible.
And that peak hit just a few months ago, January 29th, 2026. So from $29 all the way up to basically $110, and now we're settling back down in the $73 range. It's like a bungee jump.
That's actually a great analogy.
Yeah.
And that extreme swing, it dictates the overarching trend direction we're dealing with right now.
How so?
Well, because the immediate short-term momentum is undeniably bullish, right? With that recent 12% pump.
Yeah, definitely looks green right now.
But if you pull the chart back and look past just the last couple of weeks, the asset has actually been trapped in this wider, medium-term falling trend channel since that massive January peak.
A falling trend channel. Explain that for the listener really quick.
Sure. It basically means that every time the price tries to recover, sellers step in at a slightly lower price than they did the previous time. It creates this downward stepping staircase.
Okay, but I want to push back on that a little bit.
Go for it.
If we just jumped 12% in 2 weeks, and the buyers are clearly in control today, why should a regular trader care about a downward staircase that started back in January? Isn't the momentum right now all that really matters?
I get why you'd think that, but it matters because of something called overhead supply and institutional memory.
Overhead supply.
Yeah. Think about it. There are thousands of investors who bought into the hype at $90, $100, even $105 back in January.
Ouch. Yeah.
Right? And they're currently sitting on massive, painful losses. So as the price creeps back up towards, say, $75 or $80, a lot of those trapped buyers are going to use that recovery as an opportunity to sell and just break even.
Ah, I see. So they're just waiting to get their money back.
Exactly. And that creates a natural ceiling, a resistance zone that the current momentum has to fight through.
So you have fresh buyers trying to push the door open, and these trapped buyers leaning against the other side trying to get out.
That is exactly what's happening.
Yeah.
Naturally, when you see a battle like that, your first instinct is to want to look at the underlying fundamentals, right?
Sure, you want to check the math.
Exactly. You want to see the company's financials to figure out if a $73 valuation actually makes mathematical sense. So, I pull up the ticker looking for an income statement. I hunt for the quarterly and annual earnings reports. I want to see a balance sheet, track the free cash flow.
Good luck with that.
Right. Because when I went to run those standard fundamental checks on SLV, I hit a total brick wall. There's absolutely nothing there.
Yeah, that's because traditional financial modeling completely breaks down here. I mean, what's fascinating here is that SLV isn't a corporation.
Right.
It doesn't manufacture a product, it doesn't hire employees, or report a quarterly profit margin. It is a grantor trust.
A grantor trust.
Yeah,
Sure.
its singular, exclusive purpose is to stockpile physical silver bullion in vaults, primarily over in London and New York.
Which drastically changes the metrics we have to use. We aren't looking at revenue at all.
Nope, not at all.
We are looking at a massive $35.68 billion pool of net assets.
Which is huge.
Huge. And we're looking at 543 million, specifically 543,650,000 shares outstanding.
Right.
And then you look at the expense ratio, which is 0.50%, which is basically the management fee you pay them to cover the security, the insurance, and the storage of all that heavy metal so you don't have to bury it in your backyard.
Exactly. It's a convenience fee.
But here is the major discrepancy I found, and this blew my mind.
Okay, let's hear it.
The net asset value, or NAV, which is the literal real-world value of the silver backing every single share, is sitting at $71.81.
Okay.
But the stock price closed at $73.63. Doesn't that mean shares are currently trading at a premium? Like, people are paying nearly $2 more for the paper share than the physical silver inside the vault is actually worth.
Yeah, they absolutely are. And paying a premium to NAV like that, it's the equivalent of paying a hefty cover charge to get into a really crowded restaurant.
Oh, that makes sense.
Right. The food inside costs exactly the same once you sit down, but you're paying extra just to skip the line and get a table immediately.
An impatience tax.
Exactly. In the financial markets, we literally call this an impatience tax. Investors are so desperate to get exposure to silver right now, today, that they're willing to pay a markup just for the instant liquidity of a stock exchange. Because the alternative is dealing with the logistical nightmare of buying, transporting, and securing physical bullion themselves.
Right. Nobody wants to lug around 100 pounds of silver.
Exactly. So that premium, it reflects current market sentiment.
It's essentially a real-time thermometer for market fear or urgency.
It measures immense, immediate safe haven demand. But here's the catch. Because we don't have traditional earnings or, PE ratios or cash flow multiples to anchor our valuation, it leaves us in a really vulnerable spot.
Because we can't use a spreadsheet to say, oh, $73 is objectively cheap.
Precisely. We have to rely almost entirely on technical signals, supply and demand macro factors, and the order flow to figure out who is actually moving the market.
Well, then let's dive straight into those technicals, because that is where the debate over whether this is a value play or a value trap really heats up.
Yeah, the charts are wild right now.
So looking at the moving averages, the current price of $73.63 is sitting comfortably above the short-term 5-day simple moving average. That's down at $71.58.
Right, which shows strong, immediate momentum.
But the really critical event happened right at the closing bell on April 17th. The price crossed above the 50-day simple moving average of $71.46.
Yeah, and that crossover is a major psychological and mechanical trigger in the market.
Well, break down the mechanics of that trigger for the listener. Like, why does one line crossing another line on a chart actually matter so much?
It matters because the market is heavily automated today. I mean, when the current price crosses above the average price of the last 50 days, algorithmic trading systems interpret that as the short-term momentum officially gaining dominance over the medium-term trend.
Oh, so the robots take over.
Pretty much. It acts as a green light for quantitative funds and trend-following algorithms to just automatically start buying.
Right.
It creates this wave of purchasing power purely based on the math of the chart.
And we can clearly see that wave in the volume data. I mean, the liquidity here is staggering. We're talking about a 30-day average volume of nearly 40 million shares trading hands.
That's a massive amount of liquidity.
It really is. And we can also see that the institutional players, the smart money, they are actively defending the zone between $70 and $71.50. It's like they've drawn a literal line in the sand right around those moving averages and just refuse to let it drop below.
Right, they're stepping in and buying every dip.
And combine that with the options market, where the
Yeah.
sentiment is wildly bullish. Over 70% of the call option volume is stacked right at the $75 strike price.
Now, that options data provides a fascinating look into market maker hedging.
How so?
Well, when retail and institutional traders buy a massive amount of $75 call options, the market makers who sold them those contracts take on significant risk.
Right, because if it hits 75, they have to pay out.
Exactly. So to hedge their exposure, as the price of SLV creeps closer to $75, those market makers are forced to buy actual shares of SLV.
Wait, so the higher the price goes, the more shares the market makers have to buy.
Yes, it creates a mechanical feedback loop. The higher it goes, the more they buy to stay neutral, which pushes the price even higher.
That sounds like a runaway train, but I have to throw a massive wrench into this bullish narrative.
Oh, let's hear it.
Because if you peel back the layers and look at the internal momentum indicators, they are flashing bright red warning signs.
They really are.
Specifically, the 14-day RSI, the Relative Strength Index, it is currently screaming at 78.73. And for anyone not, staring at a Bloomberg terminal all day, the RSI measures the speed and change of price movements.
Right.
Anything over 70 is considered extreme overbought territory, and we're almost at 80. Add to that the MCD indicator, which looks at the relationship between different moving averages. It is incredibly mixed right now.
Very mixed.
Yes, there is a buy signal on the longer 3-month chart. But if you look at the shorter time frames, there is a bearish histogram divergence. It moved from negative 0.02 to negative 0.12.
And that bearish divergence on the MACD is a crucial concept to grasp. I mean, the MACD histogram basically measures the distance between a fast-moving average and a slow-moving average.
Okay.
So when the price of SLV hits a new high of $73, but that histogram actually gets smaller and moves further negative, it tells us something vital about the underlying momentum.
Which is?
It means the car is still rolling forward down the highway, but the driver has completely taken their foot off the gas pedal.
Wow.
Yeah. The forward motion is just residual momentum at this point. The engine isn't actually pushing anymore.
I love that analogy. The foot is off the gas. So when I see a stark divide in the market ratings, where alternative and AI data platforms have formed a consensus of a cautious hold, but then traditional technical platforms like investing.com are screaming strong buy purely for short-term traders, I have to ask a hard question. Aren't retail traders walking blindly into a value trap if they buy the hype right now? I mean, if the RSI is pushing nearly 80 and the car has taken its foot off the gas, aren't everyday investors just buying at the absolute top, effectively providing exit liquidity for the institutional smart money who bought down at $60?
I mean, the data strongly suggests they might be.
Really?
Yeah. Validating that concern is important because the risk of providing exit liquidity is exactly why we look at secondary metrics like the Arun indicator.
What does the Arun tell us?
The Arun specifically measures the amount of time passing between new highs and new lows. It helps identify when a trend is exhausting itself. And right now, the Arun indicator is actually calculating a 90% probability of a strong downward move ahead.
Wait, 90%?
90%.
That is a staggering probability for a reversal.
It is. And it really exposes the psychology of a value trap. Because retail traders often operate on a FOMO cycle, the fear of missing out.
Right. They see the chart going up and they jump in.
Exactly. They see a YouTube video about a 12% surge, they see the price crossing the 50-day moving average, and they buy in emotionally, assuming the line only goes up. But the institutions, they operate on mechanics, not emotion.
So they were buying when it was boring.
Precisely. They accumulated their positions when the market was quiet and the price was sitting at $65. Now that retail demand has stretched the rubber band as far as it can go, which is what that near 80 RSI indicates, the institutions begin systematically unloading their shares to the late arrivals.
Wow.
So a healthy correction, a snap back to reality, isn't just possible right now. It is mathematically necessary to reset those indicators.
So we have this massive clash. The technical indicators and the algorithms are screaming that the paper market is exhausted and due for a pullback. But to figure out if that pullback will be a minor speed bump or, a total collapse, we have to look completely outside the charts.
Absolutely.
We have to look at the real-world news and the macro catalysts driving the physical metal itself. Because at the end of the day, silver is not just a digital ticker symbol, it's a physical element constrained by the laws of geology and logistics.
And those physical constraints are ultimately what separates silver from something like a tech stock. You can infinitely replicate software code, but you cannot print physical silver out of thin air.
Right. Here's where it gets really interesting. Let's explore the bull case. This is the best case recovery scenario that makes some analysts think SLV is still undervalued despite all those red technical flags we've just talked about.
The physical demand side.
Exactly. The primary driver here is durable, surging industrial demand coming specifically from the green energy sector. We are talking about photovoltaics, solar panels.
Oh, the solar demand is incredible right now.
It's massive. The world is transitioning its power grids and building solar farms at a staggering exponential rate. And silver is a highly conductive, irreplaceable component in manufacturing the silver paste used in those photovoltaic cells.
And we really have to emphasize that this kind of demand is structural, not speculative.
What do you mean by that?
Well, when an investor buys a silver bar, it goes into a vault, right? And it can be sold back into the market tomorrow. It's still part of the liquid supply.
Sure.
But when a factory buys silver to manufacture a solar panel, that metal is consumed. It is locked onto a rooftop or in a desert solar farm for the next 25 years. It is permanently removed from the available supply chain.
Which is actively creating massive structural supply deficits globally. I mean, there literally isn't enough raw ore being pulled out of the ground by mining companies to meet the insatiable needs of the green energy transition, let alone the traditional safe haven demand from investors.
The miners just can't keep up.
Right. So if that narrative holds true, the bulls believe this industrial desperation could easily push the price through the major technical resistance zone we mentioned earlier, that $75.50 to $77.20 level.
And if it breaks that ceiling,
the next target is reclaiming the recent 30-day high of $81.28.
So if we connect this to the bigger picture, the entire bullish thesis rests on the idea that physical reality will simply overpower short-term technical weakness.
Wait, let me challenge that premise, though.
Okay, shoot.
If the demand for solar panels is truly structural and undeniable, why does a bearish MACD divergence even matter? Shouldn't a manufacturing sector starving for physical metal just steamroll over a couple of technical chart indicators?
Well, in a pure physical market, yes, it absolutely would.
But SLV isn't pure physical.
Exactly. You have to remember that SLV is a derivative paper market proxy. It is heavily traded by hedge funds and speculators. So while the factories in Asia are buying physical contracts for immediate delivery, the Wall Street friends are trading the SLV ticker to speculate on the price direction.
I see.
The two markets are tethered together, sure, but the paper market can detach from physical reality for weeks or even months at a time. The tail can temporarily wag the dog.
That makes total sense.
Furthermore, there are significant macroeconomic risks that could rapidly alter that physical supply and demand equation anyway.
Which brings us to the bear case. The worst case continuation lower, where that descending friend channel we talked about resumes. Because we established that SLV has no internal earnings to support its price, it is incredibly vulnerable to external macro shocks. And there are massive risks looming right now.
The supply side of the equation is highly dynamic. People forget that.
Let's talk about Mexico, because there are currently ongoing widespread mining strikes in Mexico, which is an absolute powerhouse when it comes to global silver production.
Oh, massive producer.
Whole regions dedicated to pulling this metal out of the earth have been paralyzed. But if those labor disputes are suddenly resolved and the miners go back to work, it could instantly flood the global vaults with new supply.
Which would effectively erase the deficit the solar industry is supposedly facing.
Right. An influx of new supply is a direct threat to the premium pricing. But beyond the supply chain, the broader macroeconomic environment poses an even greater risk to the paper valuation.
The Fed?
Yep. Because silver is priced in US dollars globally, and holding a physical metal does not pay a yield. It doesn't pay a dividend like a blue chip stock, and it doesn't pay interest like a government bond.
Which means the Federal Reserve is the ultimate wild card here.
Always is.
Yeah. If inflation remains sticky, and there are fears of the Fed hiking interest rates or, even just keeping them elevated for longer than expected, the U.S. dollar strengthens.
And a strong dollar is the historical enemy of precious metals.
100%. The mechanism is really simple. If the dollar gains purchasing power, It takes fewer of those dollars to buy an ounce of silver, which drives the nominal price of SLV down.
Makes sense.
Plus, think about the opportunity cost. If you can get a guaranteed 5% return sitting in a risk-free treasury bond, the idea of holding a volatile metal that actually costs you a 0.5% expense ratio just to store it becomes very unattractive to big money.
They'll just take the guaranteed yield.
Exactly. The bears argue that if those macroeconomic headwinds pick up, if the dollar rallies and the Mexican strikes end, it could trigger a brutal capitulation.
A wave of selling.
Yeah, all those retail traders who bought at $73 on margin, they would be forced to sell, plunging the price through support levels and sending it all the way back down toward the $60 range.
Man, it is just an incredible contrast to observe. You have the ultra-modern, futuristic demand for green energy, solar technology, battling head-to-head against old-school foundational economic impacts like Mexican mining strikes and the interest rate policies of the Federal Reserve.
It really is. Evaluating SLV requires you to synthesize so many disciplines. You have to think like a technical chartist, an industrial supply chain manager, and a global macroeconomist all at the exact same time.
So let's synthesize this for the listener right now. We have covered the historic 52-week crash and recovery from 29 up to nearly 110. We have dissected the trust structure where buyers are paying that impatience tax premium over the net asset value. We've exposed the highly overbought technicals with the RSI nearly touching 80 and the MACD taking its foot off the gas. And we've laid out the macro war between solar panel deficits and a strong U.S. dollar.
We've covered a lot of ground.
We really have. So how do these two realities reconcile? Let's break down the short-term versus the long-term outlook.
Well, in the short term, looking at, say, the next few days to a couple of weeks, the data mandates extreme caution.
Because of the overbought signals.
Exactly. Because the paper market is exhausted. Specifically with that Arun indicator signaling a 90% probability of downside and momentum diverging from the price. A period of consolidation is the most probable outcome here.
What does that look like?
A 3% to 5% pullback down to test the major support level around $71 is highly expected. The market simply has to digest the 12% speculative pump it just experienced.
Okay, so the short-term indicators are flashing bright red. But what about the long-term perspective for someone who maybe doesn't care about a 5% dip next week?
For them, the overarching long-term view remains deeply structurally bullish.
Because of the solar panels.
Right. The physical realities of the market just cannot be ignored indefinitely. The relentless compounding industrial demand from photovoltaics paired with constrained global mining output, it creates a foundation for immense future valuation growth.
Right.
A short-term algorithmic sell-off does not fix a physical structural supply deficit.
So what does this all mean? It means you might be looking at a bumpy, highly volatile road in the immediate future. I mean, if those technical indicators force a correction, the trapdoors could open for late buyers.
It's definitely a risk.
But the destination years from now could be a completely different story. The paper market might be exhausted today, but the physical factories are still starving.
It is the ultimate showdown between digital algorithms and physical reality. And, it leaves us with one final structural question to consider as we watch this all play out.
Oh, I love these. Leave us with a final thought to chew on.
Well, we spend so much time analyzing these digital charts, right? The RSIs, the moving averages, the mathematical representations of human trading behavior. But if global solar panel production continues its exponential curve and miraculously doubles in the next year,
Right.
completely wiping out all known above-ground global silver reserves in the process.
Oh, wow.
Will technical indicators like an overbought RSI even matter anymore? Or will the sheer, overwhelming physical reality force the market to tear up the charts and rewrite the rules of valuation entirely?
That is wild. A scenario where the physical world just shatters the digital charts. Will the rules be rewritten or will the algorithms win again? We'll just have to watch the order flow to find out. Thank you so much for joining us on this deep dive. Don't forget to like the video, subscribe, and tell us in the comments if you are buying the breakout or waiting for the pullback. Stay curious, stay informed, and we will catch you on the next deep dive.